While you're here, feel free to take a look at our risk disclosures so we're all aligned. And for everybody on the line, we will be sending out the recording. So if you do have to hop early or want to view at a later time, you'll have access to that later today. All right, with that, we'll go ahead and get started. So welcome everybody to the Arrived City Fund webinar. Our speakers today are Ryan Frazier, our CEO and co-founder, Cameron Wu, our VP of Investments, and then my name is Korin Hedlund, and I lead our investor relations team. A quick agenda so you all are aligned. Ryan will briefly walk through Arrived offerings, launching of the city funds and what that means, introducing our brand new Seattle City Fund that we just launched yesterday, new cities. Cameron will walk through asset selection and then one example property that we have in there. And then if you're new to this, feel free to drop in any and all questions in the chat. Today will be focused more on city funds as a whole, and then we will jump into Q&A. So if we're not addressing those during prepared remarks, it'll come during the Q&A session. So feel free to drop those questions. We will add them to the queue. But thrilled to have you all here today, and I'm going to welcome Ryan up to the stage.
Great, and welcome everyone. Thanks for joining. I'm going to quickly talk through an overview of some of the Arrived offerings, introduce our new city funds, and then I'll hand it over to Cameron to talk a little bit more about the Seattle City Fund. So we'll start with a few updates on our current investment products on Arrived. And for folks who might be new to Arrived, we also have an introductory webinar. So we won't spend as much time on sort of the basics of getting started with Arrived. We'll mainly focus on the new City Funds product and the Seattle City Fund. But just as a starting point, want to introduce the products that Arrived offers today and kind of how the City Funds and the Seattle City Fund really fit in that. Arrived, first of all, launched the ability to invest in shares of individual rental properties. These are long-term rentals or vacation rental properties. Today, now across the country in over 65 markets and growing each week as we add new properties. And Arrive was the first company to really adopt this way for anyone to buy shares of rental properties and earn the potential income from rental income and property value growth over time. Since then, we've also introduced our single family residential fund. So if you think about our individual properties as a way for an investor to build their own portfolio and decide perhaps which properties they want to participate in or which areas of the country they want to diversify into, and really build their own portfolio in their own vision, the single family residential fund is meant to be sort of a total market rental home fund. So the returns and performance of this product sort of mirror the average returns of the individual properties on Arrived. And for investors who really want a more passive experience, don't want to pick and choose which properties they're investing in, the residential or single family residential fund is a great option. Then we also launched the Arrive Private Credit Fund. And this was our first opportunity for investors to invest in real estate backed debt. So our individual properties and the single family residential fund are focused on equity investment in rental properties. And the credit fund is focused on credit investment in properties. And our individual and rental home fund provide a mix of returns between rental income and potential appreciation, while our credit fund provides a dividend yield. So all of the returns really coming from the distributions or dividends from earning interest payments on underlying loans. And this is a great way in this kind of higher interest rate environment to sort of be the bank and provide financing to professional real estate developers across the country to finance their real estate projects. That could be new home construction, that could be professional home renovation, or other potential financing products. And this product has, really performed well since launch, paying an 8.1% annualized dividend yield and providing a great opportunity for high yield backed by residential real estate assets. And now today we're talking about city funds, and this is an evolution in our different fund products. Really, if you think about the single family residential fund as sort of our total rental home market fund, the city fund is meant to mirror individual sectors or specific slices of the market. We believe that this is the best way to participate in the underlying real estate performance of a city that you believe in. So if you want the ability to pick and choose which markets you're investing in, similar to our individual properties, but you also want some of the efficiency and sort of ease of passive investing of a pooled fund, really the city funds might be for you. And the first fund that we're launching within the city funds is the Seattle City Fund, a market that's close to our heart, where we have a lot of team and expertise locally in the Seattle market. But also, it's been one where we've really been wanting to allow investors to participate in the growth that is happening in this market. So the Seattle Fund is one market that we plan to introduce, but really over time, we hope to have a mix of different cities across the country for investors to participate in, very similar to our individual property offerings. So with that, I'm going to take a pause and welcome Cameron, our VP of Investments, to jump on the stage and jump into a little bit more of the details of the Seattle City Fund.
All right. Thanks, Ryan. Welcome, everybody. Appreciate everyone's attendance and already see the flood of great questions coming in. So let's talk about, the best way to invest in a city you believe in. So I think Ryan summarized it nicely as far as the thesis and strategy behind the product at large. And as we deploy additional cities, would love your feedback as far as what you're looking for in investments. We're all looking for returns, but there's also differing opinions about what is the thesis and where are the highest opportunities. So please leave your feedback as we have different polls throughout this webinar. So why City Fund? Targeted market exposure. As Ryan had mentioned, there's a lot of reasons to concentrate on particular cities, and we often think about returns for the U.S. at large, large averages. But there's losers and there's winners, and we're trying to pick the winners, right? So one other component of that targeted market exposure is that I think we have an opportunity to invest in a wider range of assets than we've traditionally offered on Arrived. One of the common questions we get is, hey, are you going to offer multifamily, 2 to 4 units, 8 to 10 unit, small apartment buildings? And the answer is yes. We think it's very adjacent to what we have done as a company within single family residential. Very similar operating model, a very similar need as far as housing that is, a basic commodity that everyone needs. So there's a lot of these opportunities to then fit that profile within that city. If we take a step back and think about what in our first 4 years, what are the types of assets that we've offered as a company? They tended to be newer builds. Our average build is about a 2018 fairly new home. Price range, it's been anywhere from about $250,000 to $350,000. Growing metros, markets we believe in, but largely it's been oriented around this newer single family residential asset. So if you've ever been in the market for Seattle, you don't come across a lot of those types of assets just because the land scarcity and cost of building, cost of labor, cost of materials. So it's prohibitive in certain markets, which is why we haven't ended up in certain markets, especially more expensive ones like coastal ones. But as we concentrate our investment thesis on these different cities, it opens up the opportunity to create these blends of both single family residential assets, large pieces of land, and then on the other side of the spectrum, denser housing that are more cash flow dense, like these duplexes and fourplexes that are more common forms of housing in denser areas like Seattle or New York or Boston. But coastal areas tend to be more expensive. So that's where these asset plays can come in. Optimize fund economics. So as Ryan mentioned, with credit, we have the opportunity to both layer in really great performing assets at the rental level and then have really good cash utilization through our expanded credit capabilities. So at Arrive, we're building all of these different asset classes and they start synergizing together because you can start picking and blending yields together for that optimized fund. And then built-in diversification, so it's kind of funny that we talk about diversification in this sense, because on one hand, with the SFR market, we're already nationwide in over 60 markets, but the asset is somewhat homogenous in terms of the profile we're looking for. So diversification, though, can mean more than just diversification of market. We can look at diversification of asset plays within that market. So, as we're building up this Seattle fund, we expect that we're going to have layers of single-family residential assets, credit assets, multifamily assets, and there's diversification in that way across the asset spectrum, more so than the geographic spectrum. So specifically, why Seattle? I think there's a lot of good reasons to be bullish on it. First, it's a thriving tech and business hub. In addition to, probably the most famous company coming from Seattle, Amazon, there's a lot of diversified industries here. Largely, the Western Washington, the Seattle area, was fairly industrial before the whole tech boom. Starbucks was a nice company to put the name, put Seattle on the map. But there's a lot more industries that go beyond just tech, even though it's kind of what Seattle's become known for. There's really strong rental demand here. There's a very, very constrained supply of homes available. And that largely has to do with limited land supply. Washington is very protective of its environment, and there's a lot of people here. So bringing supply online of new housing that is close to all of the infrastructure has been a challenge that the city has faced. But as such, on the bright side of things, as an investor and as a landlord, there's very strong rental demand, high rents, and a pretty stable market. And quality of life and infrastructure are really good here as well. So there's a little tidbit here that Seattle is even further north than the northernmost point in Maine. It's further north than Toronto. It's further north than Montreal. So you would expect that this should be a really cold place. But the Pacific Ocean keeps us quite warm, relative to how far we are north. And things just grow well here. So the weather is great. It's a beautiful place to live. There's a lot of outdoor activities. It can be a little bit overcast. It can be a little bit rainy, but it usually doesn't get in the way of life in the way that really heavy blizzards and heavy snow can for areas that are this far north. The infrastructure is really great here too, in terms of being very cognizant. I think the city is very cognizant of building infrastructure that helps people live in a higher density environment. So the light rail is a major, it's a major infrastructure project that runs north and south throughout the entire region. And it helps, the economy thrive. It helps get people moving. So very intentional infrastructure investments that the city makes is also why we feel great about investing in Seattle long term. So more tactically, what are some of the areas that we like and for what reasons? So municipalities with larger average lot sizes, and I'll go a little bit into the legislation that drives our thesis around average lot sizes. Let me first go through some of these bullet points. So close to the highway and the light rail infrastructure that I was just mentioning, and options to travel east side, Seattle proper going south, and Everett going north. Everett is the home of Boeing, and it's a pretty large city that is outside the Seattle proper, but still within the general Seattle MSA. It's in a different county. It's called Snohomish County. And the border between King County, which is where Seattle proper is in, versus Snohomish County, it's not that far away from the core city. I personally live in the southern part of Snohomish County by I-5. It takes me about 20 minutes to get down to South Lake Union, which is where basically it's all of Amazon, and a lot of the tech corridor is in South Lake Union. There's also one on the east side called Bellevue, Kirkland, Redmond. So famously, Redmond is the home of Microsoft, and Bellevue, Kirkland, like that's a big, big tech hub. But it's divided by Lake Washington. So, if you're too isolated on either the west side or east side, it can be a little bit tough to get to different places. But there's a little sweet spot at the intersection of two freeways, I-5 and I-405. There are two major interstate freeways that go through that connect in Seattle. So we particularly like that area because it gives you optionality to get to the north in Everett, Seattle proper, and east side, all within a reasonable amount of time. And I-5 running through that is basically where the light rail is following. So it's close to a lot of infrastructure, and that's why we really like those areas. In addition, it also has those larger lot sizes, because before Seattle got very dense, those areas used to be more rural, agricultural. So the average lot size there is actually quite large, which gives us the opportunity. And similarly, lower crime, less density, lower cost per square foot. That's kind of the formula we're looking for in terms of value. Like, where can we find that value? Where can we find where people are moving towards as they get priced out of those denser areas? Okay, so I was going to talk about some legislation. So there's 2 House bills passed at the Washington state level that's really driven our thesis around our investment strategy within Seattle. Okay, so now let's get specifically to the asset selection. The first one is called House Bill 1337. This was passed in 2023, but it's applying to all of the cities and townships. They had about 2 years to incorporate it. So starting July 1st, it's going into full effect for the areas that we're considering, largely in Snohomish County. This has actually been active in Seattle proper for about 1.5 to 2 years now. So there's kind of a model that we can follow, and some expectations about how is this going to work. But what this bill says is that for any existing property, you can add up to 2 ADUs. ADU stands for accessory dwelling unit. You may have heard of this before as kind of a smaller house that you can put on a piece of land. California passed some of these laws in, I think, 2019 or 2020, and it's been addressing some of the housing issues that they also face in terms of density, affordability issues. So it's largely aimed at addressing those for the state of Washington as well. So the reason why we go for those larger lots is because you can reasonably put those additional ADUs on there. Now, whether we actually put them on or not is less important than the land having that option value built into it. And what I mean by that is, when a law is first rolled out, you want a little bit of time to see how the market reacts to it. You want to see the ecosystem around vendors start building up. We want to see more people offering construction services, ADU build outs. That competition will drive the cost of building down. So it may not be the strategy to immediately start building, but over time, there exists more certainty to execute on that plan. But as long as you have that land where you can build it and it has the appropriate configuration to comfortably put those units on, then that's where the value is, from our opinion, on and why we have the thesis that we have. There's another legislative bill called House Bill 1110. This is called the middle housing legislation. This applies more to ground up construction, but it's still relevant to our investment thesis, because if we buy good land, that also has a lot of value in it. There's a structure on there that's not worth investing in. You could always tear it down and then start with new construction. But there's a lot of different laws now, or provisions within House Bill 1110 that get you a lot of density on different lots, which increases the value. So the whole strategy of the Seattle market, from our perspective, is to find the opportunistic land in those strategic locations, knowing that the bill is passed, that there will be people that have affordability issues. They may want to live in the suburban areas, and this might be the right form of housing for them. So going to the property selection and underwriting process, we underwrite rents relative to the cost as we would for any home. But and that's kind of the science, the nuts and bolts behind underwriting rental economics. But the art, which investing in properties is always art and science. The art is very important here. So when we're looking at properties, it's very much an intense like Google Maps exercise. You go to the street view. Does the side lot have sufficient access where you can get a car to go beyond the lot line, and can somebody park close to that ADU? Is the lot shape good enough and not obstructed by trees where you can put in fence division lines and effectively subdivide it a lot into different living spaces, such that you're creating new SFRs out of it? So there's options when it comes to how you can monetize that land. You can either parcelize it, which gets a little bit expensive, but Washington State also has a condominiumization law, where basically you can turn a lot with multiple structures into a condo. And the kind of the efficiency behind that is that you don't have to actually get reparcelization, which comes with kind of a lot of baggage when it comes to improvements that you have to make in dealing with municipality administration. But like the Condominium Act will allow you to effectively sell off pieces of it without the parcelization. So we're looking for all of those types of signals, both from like aerial views and street views, to see, does the lot work? We also have the benefit of being local here. So, you know, as we're buying inventory, we're checking these houses out. We're making sure that, hey, yeah, you reasonably can. Sometimes it's a little bit difficult to see grading issues, and that can be expensive to fix. So we like nice square lots, flat land, big setbacks where, you know, you can efficiently build, driveways that you can, you know, go beyond. Love RV parking. One of the properties that we are under contract on has a nice wide separate driveway for RV parking, which is perfect to get another vehicle through to efficiently place the detached ADU. So the criteria for acquiring properties in a city fund, you know, what I had just described with respect to the land is largely that criteria. Now we're looking also for properties that are not necessarily turnkey, but we want to neutralize some of the risk of a roof that would need to be replaced, old wiring. There's a lot of older homes, you know, in the Seattle area, especially in the area we're looking, you know, we're talking built in the 50s and 60s. As you get closer to Seattle proper, you're looking at properties that are built in the 1900s. So we definitely have to do a lot more due diligence in looking for these properties. Property condition is a big issue. So things that are more recently renovated, we still err on the side of going towards that, especially because labor is extremely constrained in this market. There's not a lot of trade labor where you can easily and, you know, cost effectively, you know, perform the value add. So we're looking for that somewhat turnkey home, but more importantly, the value is in the land. So here's an example property that we are imminently closing on. It is, we've named it the Bolito. It's an $825,000 property, 3-bedroom, 2-bathroom, very nicely renovated. I've been in this house personally, 1375 square feet. So it's a great rental. I think that, you know, it's highly desirable. It's in the right price point. It's extremely convenient. There's a freeway entrance less than a mile away to I-5, very centrally located, and super convenient. But what I really love about this property is the lot, 11,760 square feet. So that's over a quarter acre. It's about 0.27 acres. So there's plenty of side yard to provide accessibility. The streets are wide here. And, you know, very importantly, on that street, you can see progress and improvement. There's new homes being built. There's homes getting renovated. So you feel good about the location, the thesis, the lot, and then utilizing it as a rental. It's ready to go. It's ready to move in. So we liked a lot about this area, liked a lot about this house, and we love the land. So this is a nice example of the type of single family residential asset that would be in the city fund. And that wraps up kind of the tour and the thesis and the rationale that's driving, you know, why Seattle and what kind of inventory. So I'll invite Ryan and Korin back on stage, and we'll take any questions that y'all have.
Fantastic. Cameron and Ryan, thanks so much for prepared remarks. Absolutely exceptional. Lots of questions coming through the queue. I know we have a few that are like kind, so if I jump around, know that we'll come back to them. And then as we get toward the end, at the top of the hour, I'll be sure to ask if I've missed any, and we want to be sure all your questions are answered. So we will jump right in. The first one is from Mark. Can properties in the city funds be purchased individually, or are they exclusive to the fund? Cameron, I'll kick that to you.
Yeah, so within the investments in the fund, they're wholly owned by the fund. So unfortunately, we can't really piecemeal the individual sale of shares of that. They all roll up to the same fund, wholly owned. So unfortunately, the answer is no, but there'll be plenty of great properties in the fund. And Additionally, as we look at City Fund and really get comfortable with it, there's also the opportunity to offer properties individually in those cities that are, outside of the fund, but anything in the fund is squarely in the fund.
Absolutely. Well, that leads right into another one. I'm going to skip ahead. I know a few folks asked this. Bill had asked, and I know we've had this when we released the single family residential fund as well. It's a little bit different with city funds. How will Arrive decide if a single family individual property should be added to a city fund or a standalone single investment? I think Cameron too, like this one is, and Ryan, Seattle's net new to any market that we've had to date, whereas we've had a few new markets pop up in that single family residential fund. So I'll kick to you, Cameron, and then Ryan, if you have any color there too.
Yeah, I think so. For this question, let's assume that there was a city fund where we are also purchasing assets individually, right? So how do we kind of navigate that decision? I think it really comes down to the thesis and which asset best supports that thesis. So if in the city fund we have defined criteria that strongly aligns with a particular asset, and let's say it may be multifamily, it could be a duplex. And the purpose of the city fund is to create this diversified portfolio of strong assets within that trade area. It would probably make more sense to usher that into that particular city fund. If there's a more general thesis with our SFR strategy and it's conducive to that and it's not accretive to the fund, then it could go down the path of being individually offered. A lot of times when we go under contract on properties, we like it, right? And there's not an adverse selection process where one gets leftovers or vice versa. It really comes down to, does the asset match the thesis of that offering? And if it does, and it's accretive and it's balancing that portfolio, then it's a good time to put that in. And if it's not, it's an asset we like, but it's not accretive to the thesis, then it can go down the individual path.
Oh, Korin, you're muted.
Shoot, I've been doing so good at that. I see another one popped in here. Cameron, if you just want to double down on this, will there be overlap of the single family residential properties and the SFR properties and city funds, meaning there could be a double investment? So I just want to clarify this because I saw a few more. I think Brandon Stein had asked as well. Ooh.
And
so individual properties are going to be at this time wholly owned by the investment structure that it goes into. So to the extent that something goes into the fund, wholly owned by the fund. So there's not really a overlapping of that same property in two different investment products that you would be invested in.
Fantastic. All right, we'll move on to returns. I know there was quite a few folks that were asking about cash flow, returns, what they can expect. And Paige, I know is one, David, a few other folks on the line. What is the expected dividend rate for the city fund? Brian, perhaps I'll kick it over to you. And then Cameron, if you have any color there.
Sure. Yeah. So the returns for the city funds and for the Seattle fund are sort of meant to mirror what investors are used to in the single family residential fund and individual rental properties. So investors should anticipate to receive both a dividend and also the potential for share price growth from property value appreciation. We expect with the strategy that Cameron talked about around the rental properties that we're acquiring in the locations we're acquiring them, and with some of the mix of credit that we'll have in the fund, that will target a 3% or higher annualized dividend yield. And then in addition to that, the potential for appreciation. The Seattle market over the last 20 years has averaged 4.7% annual appreciation. And over the last 10 years has averaged 8.5% annual appreciation. And so we do really want to, target properties that have the potential for that property value growth over time. And so the thesis that Cameron mentioned on acquiring assets within the kind of path of population growth and really close to the transit corridors in Seattle, things like the light rail and the extensions of that heading north, as well as larger lot sizes where we can add the potential for additional units or subdividing lots even. That's what we believe will allow us to achieve the best possible results for the appreciation potential in the metro. So that's a little bit about what to expect around the potential for dividend yields and property value growth over time.
Absolutely awesome. Thanks for walking through it. The both of you, let us know if there's any color or clarification. I know there's quite a few folks that asked that, so we'll be sure to send out the recording as well, and hopefully that provides some confidence in investing. All right, looking at this question, how does the Arrive City Fund investment compare to other city funds that we've seen? Ryan, obviously, I've seen a few mention of others in the chat too, of other great companies or traditional investments. What would you say would be Arrive's differentiator in the space?
Yeah, I think when you think about Arrive versus, something like public REITs or the ability to buy whole homes on your own, the benefits of Arrive have been more or greater control in terms of where your investments are going than these large national public REITs. And I think the city funds are really continuing down that path, giving investors the opportunity to control which markets that they're investing in. But with still the benefits of a pooled portfolio. And then when you compare that to the kind of buying whole homes on your own, really the city funds give investors the potential to diversify their assets, invest in a number of properties in that market than if they were sort of using that same capital to buy a whole home in that location. So that's really how we think about the benefits of city funds and Arrived overall. And then I also was going to say that it might be an opportunity to talk about the credit investments as well. I've seen a few comments or questions about how residential credit might work its way into some of the city funds. And you'll see this on the investment page and on our investment thesis for the Seattle Fund and city funds, is that now that we've built a great partner network for residential backed credit investments as well, we plan to use that for sort of cash management or treasury management within the funds. And so at any given time, we might have a larger allocation of short-term cash, either because we're looking for new equity investments, so new homes to buy in the market, or because we're holding cash reserves for things like property improvements, maintenance, one-time expenses, or even for the supporting our redemption program. And so we have the opportunity now with this great credit partner network to layer in some of that so we can get better yields on our cash. And so that really allows us the potential to get more than double the yield on our uninvested cash than we would be getting if we're holding it in something like a high yield savings account or money market fund. So it's a great option, for the Seattle Fund. And it also gives us a lot more control of timing the equity investments we're making so that, we're not really forced to make investments in properties. We can really be very strategic about the assets we're acquiring into the fund, that it lines up with the thesis that Cameron mentioned, but meanwhile, not really giving up the potential for returns.
Absolutely. Fantastic questions. I know a few folks had that one in particular about debt being included within the fund. So let us know if there's any other questions there. Happy to jump through. Lots of good ones. Cameron, you walked through this one briefly in prepared remarks, but I think it's always good to double down on, especially when we've had a lot of our buybacks has been younger and the Seattle properties are going to be older. And there's a mention of the roof. So maybe we can mention that one as well. I see the initial two Seattle properties are not newish. This seems inconsistent with many and most of the Arrive single family residential offerings. Is there any strategic intent that investors should take from that, or just a coincidence? And then if you'll just chat through the roof on the specific property that you mentioned in prepared remarks.
Yeah, sure thing. So you're definitely correct, Ken, that most of the properties that are going to be available to us that fit the thesis that we're trying to execute do not tend to be new. And in fact, in the Western Washington, you'll be hard pressed to find much new inventory at all. There's some infill. There's properties that a developer may have gotten for pretty cheap, tore down the property, built it up. A lot of times those are very, very premium priced properties. We're talking $1.5 to $2 million type properties. So to the extent that we're looking for properties that kind of have that value add potential, a lot of times it can be challenging to invest in a $1.5 million property, get a sufficient rental yield, and have the upside that we're looking for on the appreciation component. So it is a very specific strategy that is a big divergence from our more national single family residential strategy, as well as with the SFR fund. You can think about the single family residential fund as a nice cross section of the assets and markets that we have purchased throughout the first 4 years of our history, and offering them individually. The Seattle fund is a significant departure from that. And if you kind of look through our offering history, we haven't had a Seattle property ever as an individual rental, and it's because it hasn't really fit that initial rollout of that thesis for the nationwide SFR. So within the market, we kind of bucket this as that city fund because it is such a different asset strategy that requires just a very different outlook on that. So, it is intentional. If there was newer inventory that was affordable, that has upside, you'd better believe I'd be a interested buyer in that. But so would the rest of Seattle. So it's a very competitive market here. Land is at a premium, but we're trying to find the best way to find the upside. And we believe that the way to do it is to buy those larger lots near the infrastructure, not pay too much for the house, but have a lot of value embedded in the land. And that just tends to be consistent with having that older inventory profile. But if we're kind of trying to thread the needle between rental economics, then we're looking for those, not a complete fixer upper, because there's a lot of risk involved in performing that value add. I think we could get there eventually as we grow larger as a company. But for now, what makes more sense to us is to have a pseudo turnkey-ish, such it's very attractive to a renter on the market, quick cash flow, high retention. That way we can kind of bide our time, let that land value marinate, but acquiring the land is the name of the game right now. And we want to provide good cash flow in the meantime with those more turnkey-ish assets. But we believe at the price points we're purchasing, there's still a lot of value add upside, more so in the land than a new build home.
Absolutely. Yeah. Fantastic question. Appreciate the due diligence. For new folks on the line, we always showcase specific property details, even if they're within the fund. So you'll be able to see the year it's built, bedroom, bathroom, square footage, so on and so forth. I know we have folks that like to dig in there. All right, moving back over, I think inevitably when we release a new product, it's what's next. So Ryan and Cameron, maybe you want to walk through any cities that we have planned. I'm also going to drop a poll. I would be curious if folks are interested in the existing markets that we have. I just shared examples, so not just those two, but any of the 60 plus we have, or if you'd like to see net new markets. So Cameron, I'll kick it to you first, and then Ryan, if you have color on that as well.
Yeah, so there's a really wide list of potential cities that we could go into that we find interesting. And as Korin mentioned, they can be both existing markets with both a focus on the SFR thesis that we've had, as well as expansion upon that. But I'll give you an example. One that comes to mind is Las Vegas. That could potentially be a city fund, with the thesis there being more of a continuing to capitalize on California outbound migration. There's a lot of people that have a lot of wealth and equity from the real estate boom in California that's occurred over the last 40, 50 years. And as they kind of age out, look to retire, they're not working anymore. So they're looking to have their wealth go a little bit further for them. Las Vegas is a very attractive option. I used to live in Las Vegas before Seattle, so know the area well. Can kind of anticipate the thesis. We've got team members there as well. So I think Las Vegas has a very interesting thesis that also aligns with the availability of the types of assets that we've been very comfortable with new builds. So there's a lot of hybrid types of investment strategies along the spectrum where you have new builds, but you also have older markets like Seattle that have a lot of value in them. But all along the spectrum, there's great properties. I think Columbus, Ohio could be an interesting one as well, similar to Las Vegas in that there's been outbound migration from Chicago, and the Midwest is still a huge, thriving area. Columbus is kind of seen as a younger, hipper, tech-oriented, large university, high quality of life place to be in the Midwest. So I think that's also another interesting city fund potential. But what I think is kind of my final point here is that city funds allow us a lot of flexibility to act on a very specific thesis. And I would say that is one of the differentiators between our SFR fund, which is looking for value, new builds, and like growth at certain price points. But city funds, we're not constrained quite as much by a particular price point or a particular vintage. But if there's going to be growth in the city, you find the thesis to capitalize on, and then you execute on that.
Fantastic. Awesome. It looks like Cameron, we might have some Michigan fans in the chat. So I'm going to give a big OHIO, go Buckeyes. But I did drop that poll. It looks like when I asked, where would you like to see city funds? 10% said it from existing and 90% said from new markets. I think it will blow up the chat a bit, but would love to hear what cities you're of interest. So feel free to drop that in the chat. We'd absolutely love to hear from you. I do have quite a bit of other questions in the chat, so we might miss some of those, but would love to hear from you all. All right, moving back over here. Let's see. Lots of questions on commercial. Do you plan to offer investing in commercial real estate assets in the future, whether it be in the fund or individual? Cameron, I'll kick it to you. Ryan, if there's any commentary as well.
Yeah, commercial can have a really wide spectrum of asset classes within that. So I would say first and foremost, we're a very residentially focused company, but that can also extend to multifamily housing. And then at a certain level, multifamily kind of becomes commercial as well as at a large enough scale. There's also mixed use, which combines that multifamily housing with, business and commerce. It's got to be at least 50% residential though. On the equity side, in terms of owning those types of buildings, we strive to do everything that we do really well. And it's a very different operating model as you go into commercial. So I think that over time, we can build those competencies and it can be on the roadmap. Probably the more, the quicker way to get to commercial real estate assets is via credit. So within the private credit fund, we could be making bridge loans on larger mixed usage, larger multifamily. And we've seen a lot of those assets on those types of tapes. So credit is a great way to get exposure to that without necessarily being involved in the intense operations that commercial would demand.
Fantastic. Always great feedback. I mentioned this in the chat, but we're building for and by each and every investor, whether you're new or existing. We'd absolutely love to hear from you. So whether it's a market update within the platform, a city, so on and so forth, feel free to share any and all feedback in there. We have all the folks in the line you'll see in chat today from a plethora of teams, which is exceptional. All right, moving back over to the queue, I saw a theme here from a few different folks regarding politics within the state of Washington. I know there was a question about tenant laws, what that looks like, and then tariffs as well. So it's a three-parter. I know that y'all will both have comments on this. So Cameron, maybe we'll start with the impact of politics on the business in the state of Washington, given this is a brand new market, a little bit different than what we've invested in so far.
Yeah, certainly. Politics politics can just kind of be summed up as like, how do people live together and interact with each other? And from a rental perspective, I don't really see much of an impact. I think that regardless of your political beliefs, if you're a competent person and make good income, you're looking for rental housing, you're in the housing market just as anybody else on the political spectrum. So from the supply demand perspective, not really seeing much of an impact on renting. From the perspective of policies from top level at the state going down, I would say that we're very protective here in Washington of our natural environment. And that's not really a political statement. That's just, we have a beautiful place to live and we want to preserve it, right? In effect, that has constrained the land supply. So to the extent that politics can impact those types of things, absolutely. And it's a large reason why we play the thesis we're doing is because land is constrained. So there's a lot of land value. There's a very top-down kind of approach to the thesis, starting from the legislative components. It's specifically, you want to check it out. It's called the Growth Management Act. That is the framework from top down of how cities implement their regulatory code. I'm actually on our local planning commission for the city that I live in. So I'm highly aware and cognizant of kind of how the legislation comes down and impacts the real estate markets. But it's not really a, wokeism or political belief. It's more about protecting the natural beauty that makes Washington what it is. As far as being a landlord, right, within King County or Snohomish County, there are differences. Recently, there was a rent, like a rent. I don't want to call it rent control. That's like too strong of a word, because it's not. I wouldn't say that this is analogous to rent control. But basically, Washington is limiting the amount of renewal increases that one could have. We read the legislation. I think it's actually fairly reasonable. I've been in rental economics for a long time, with American Homes for Rent. Before that, they own properties in Washington. We didn't feel constrained by the policy. I actually think it makes a good amount of sense what they legislated. So, there's definitely areas that are harder to operate than others. I think King County and Seattle City proper can have more challenging regulations than, say, Snohomish County with large single-family residential lots. There's a little bit less constraints, but I haven't found any of it to be particularly onerous in either direction. So from my perspective, politics hasn't really played a role in the investability and rental economics. And as Ryan mentioned, we've had 8.4% annualized growth over the last 10 years. So it's, as an investor, you look at those numbers and it's attractive, right? Regardless of political affiliation.
Fantastic. I think we cruised through most of it. I realized I didn't put the one on the screen in particular to the tenant laws. I know there was a few other questions in the chat or recommendations for other cities to invest in that are similar to Seattle or slightly different, but always appreciate the question and feedback there. Cameron, any concerns with city management issues that Seattle is facing having an impact, such things as budget shortfalls, homeless encampments, et cetera?
There's budget shortfalls. I mean, I think there's a lot going on at the state level on figuring out how to improve the tax base. We've been playing with different capital gains taxes. We're trying to find ways to support all of the things that the state and cities are trying to do without making it expensive for more of a median type of profile. Budget shortfalls, I don't think that we have had significant budget shortfalls. One thing that has concerned me is kind of the police force, in terms of not having enough of them. There's been kind of low recruitment, but I think that's on the up. It's actually been improving lately. So the best thing that we can do is to recognize the areas that are challenged with encampments and just kind of areas we don't want to be in. We can avoid those. Seattle's a large metro area, and our thesis has revolved more around large land. So when it's not as dense, you kind of avoid some of those negative externalities from denser city living that aren't specific to Seattle. We see them in all large cities, domestically and internationally. So it's not really a phenomenon specific to the politics as much as like density of human living, and that always presents challenges.
Absolutely. I'm going to group a like kind. And then Ryan, I have a question for you next. A good one in here. Cameron, we've obviously had to deal, even though this is a passive investment, we're still very much dealing with traditional things you see when you have a rental property. We've had obviously squatters previously in different properties. What would you say with Seattle in particular? Obviously, we haven't had to face this at this point, but how maybe we handle it?
Yeah. So as far as, is there a generalized squatter problem in the Seattle area? I think that in any large population that you look, there's going to be stories and headlines where there's going to be a particularly egregious situation where, you may have somebody in there for 2 years living rent free, and then, landlords or the owners trying to get them out. And, we found that all across the US. Seattle, I haven't really seen near like the level that you would think. And my reasoning or my hypothesis around this is that we're a very low supply state or low supply city. And when you have properties that are occupied and you have generally incomes that are higher, the squatter issue kind of resolves itself through market forces. The most dangerous time for a house, when your asset is at risk, is when it's vacant, because anybody can go in, anybody can change the locks, and you can effectively get the squatter problem. you may compound that also with a low supply of law enforcement, and then you can run into challenges. So I think during the early 2020s, there's probably more issues with enforcement, low supply of force. I didn't really see it impacting though the areas that we're investing in, because the density dynamics are just different. So the key is low supply, I think, and high occupancy in the market has kind of prevented the squatter dynamic from running rampant. We actually saw that more in some of the southeastern areas where the court systems were backlogged. And that was really causing and exacerbating the squatter issues, because if you can't process and get people out, it's naturally just going to build. Then kind of urban legends start spreading about like, hey, here's how you can kind of play the system. So I didn't really observe that in the Seattle area, but we definitely saw some of that, a couple of years ago in more of the Southeast.
Absolutely fantastic questions. Also, I dropped a blog post on evictions and unlawful occupancy, how Arrived handles it. It outlines everything into detail. If any properties, especially for individual in particular, face an issue like that, we outline it directly on the individual property page, and then it's under that performance tab. So feel free to jump in there and take a look as well. All right, Ryan, kicking this one over to you. It's from David. Is there a vacation home planned for the Seattle Fund, and would it be expected to perform similar to our other vacation homes? So I think that's one question. And then perhaps the one following it is, what's the current state of vacation rentals? Will we add more in the future for individual as well?
Sure. Yeah. Great question. We don't have any vacation homes planned for the Seattle Fund currently, although it is something that we could look at in the future, doing some vacation rental properties in the Seattle market. It's not something we're currently focused on. And then right now, just in terms of an update on vacation rental properties on Arrive, what we're focused on, we have just over 40 vacation rental properties across a number of cities on Arrive currently. And the team is focused on really two things. One, focusing on driving increased revenue and performance at each of those properties year over year. Now that we've developed more of a reputation on Airbnb and some of the vacation rental booking sites through our ratings and reviews and sort of track record of bookings, the majority of our properties are now guest favorites on Airbnb, as an example. And so there's a big focus on now that year over year growth in top line booking revenue. So a lot of our time is focused on that. And then in terms of new properties, we're looking at some of, a handful of select vacation rental properties that we'll likely introduce over time. I think, introduced over the last 6 months or so, 3 different properties that investors may have seen. One of the ones we were most excited about was the Byers property, which is outside of Atlanta, and a property that we completely renovated. It was a house that was used in the filming of the TV show Stranger Things, and really turned it into incredible experiential vacation rental property. Investors can, if you filter on vacation rentals on Arrived, you should see it there. And as we have the secondary market coming later towards the end of this summer, that'll also be a great opportunity for investors who may have missed out on investing on some of these vacation rental properties in the past, to potentially be able to buy shares in some of our pre-existing operating properties from other investors on Arrive. So more to come there, and future opportunities to invest into the vacation rental portfolio over time.
Absolutely. Very excited. I saw there's quite a few questions on secondary market as a whole, Ryan. It's been one of our most requested features to date or since inception. And we're working hard on building for and buy to make that accessible this summer. Do you have an update on secondary market, how it's going?
Yeah, I mean, so the secondary market and the ability for investors to buy into some of our existing almost 500 individual properties across 65 cities now, and then also the opportunity to sell shares or sort of reshuffle their portfolio makeup over time. We've been working on that for a long time now. At the beginning of this year, we received qualification through the SEC on our offerings that have the secondary market disclosures. And that allowed us to move forward on finishing the development of the secondary market. This month, actually, we've been really doing testing of the user interface and test trades. We're very close to internal trading among the Arrive team to be able to make sure that we're testing the system end to end. And then in a few months, we should be able to roll that out to investors to start using the secondary market. So more to come there. We'll also share, a lot more content about what to expect and how it will all work over the next few months. But excited to have that coming soon.
Absolutely. Couldn't be more excited. I would say liquidity in real estate, obviously, it's one of the most liquid assets to date, but you typically don't see it selling in such quick timeframes. I know there's questions on what the 1 week window will be, what the prices will be like. We'll be sure to share more details as they come through, like Ryan mentioned. For any folks on the line, anytime we're releasing a new product, we always pair it with a webinar as well as a plethora of education. We'll have our support line open. We can run multiple webinars if we need to. So we'll be here for and by you when that time comes. So stay tuned for more details. Let's move back to the queue here. And Ryan and Cameron, I know we're getting close to time. Are you two good on going over? All right, we'll keep cruising here. I think I saw one from Carol. Ryan, I'll kick this to you. Do you limit the number of investors in any one fund?
No. So we don't limit the number of investors in any of the funds. Really want to make sure that they're open for anyone to participate in.
Fantastic. It looks like Mark is excited to start buying on the secondary market. So love to hear it. Our team loves to hear that in the chat as well. All right, moving back over to the queue here. I think we were getting into some details on insurance. John had asked, do you plan to carry earthquake insurance in the Seattle fund? Cameron, maybe we walk through what insurance we have to date, what catastrophic events could look like, or why we wouldn't have them.
Yeah, insurance is always tricky because we do live in basically the Cascade Mountain Range, and there are some super volcanoes over at Yellowstone, and this can be an area that experiences earthquakes. Insurance, cost is relative to the risk. So as of now, we don't carry earthquake insurance. We're constantly looking at the risk footprint with our insurance carrier. So we have a master policy with an insurer that brings a lot of efficiency benefits for managing the national portfolio that as an individual owner, you might not be able to get, better pricing and just basically having a larger account with the insurer. So we have commercial protections on our insurance policies. Probably the most notable one that's relevant to our investor base is basically getting comped for lost rents. So to the extent that you have an insurable event that renders the home not usable, Florida may be a good example. So if we have a property in Florida, would very likely have named hurricane insurance on it that protects against the wind damage, because in hurricanes it's really the wind that messes everything up. So to the extent that you have a tenant in there who's renting a property for X dollars, if they can't live there anymore because there is a covered event, then we would not only get the funds necessary to repair the property, but also get the lost rents. So those commercial protections are how we structure our policies. And at the individual property level, we can elect various coverages depending on the severity of the risk. We haven't found that the risk premium on the earthquake insurance kind of is justified. With that said, pricing changes on an annual basis for insurance. So we get a new look at it every single year for any type of kind of categorical risk that may exist for any property. But as of right now, there's not a plan to have earthquake insurance, but we get the rates in front of us on an annual basis.
Absolutely. I think the other one we get asked about often for other markets is flood insurance. Mm-hmm. And flood insurance would be included if it was in a FEMA flood zone.
For sure.
And then, sorry, Cam, did you have a comment on that piece?
Oh, sorry. I was agreeing. I was like, for sure. Like the flood insurance of FEMA is like a very important, that one is very required. So let's just say that.
Absolutely. And I would say too, for any folks that haven't had a property that could be in a catastrophic event place, that Cameron and the team are always working directly with our property managers to ensure the property is set up for success as much as it can be. And then we are also notifying the investors that we're watching any storm that's taking place or catastrophic event. And then if we have any major impact to that property, we would update that property performance tab. We haven't had major to date. For example, if there was a rock that hit a window, we probably would not be notifying. It'd be more so if like a roof was ripped off, major impacts, so on and so forth. But we also want to make sure our tenants are safe and then maximizing those returns for our investors. All right, moving back over to the queue. I know we have quite a few more questions in here. There was one on ADUs. I think there's a couple in here in MDUs. How would your fund improvements on these lots, ADUs, or complete teardowns? Cameron, I'll kick that to you.
Yeah, this is a great question. So within the fund itself, it's an open fund structure where we can keep inviting dollars to coming in. So it's a continuous offering. So let's say that we're fully deployed on cash, we've got a great portfolio of properties, and then we decide, okay, now's the time to strike for us to build the ADU on the property. So as the next tranche of investment streams in, we can use those dollars to improve any of the existing properties within the portfolio already. It's a bit different than the individual offering where when we offer it, there's a set amount of capital that is raised for that. Now there's options in that, like once it's funded, we could open up another round for that particular property, but it's a lot more efficient for us to do this within the fund structure to kind of flexibly use those dollars across the entire portfolio instead of having to treat it kind of as an individual isolated investment. So it's also kind of what informs our asset strategy of what goes down the individual path, what goes down into the funds. We're looking for those turnkey newer assets in the single family residential individual offerings that can get a good raise, you get the cash reserve, and it kind of self-sustains itself through the income. But with the fund, when we have more complex value add possibilities, then it's definitely good to have that in the fund structure to deploy it when the time is right.
Fantastic. And I'm going to move on this theme here. I think Renner had a follow-up. Will these bills supporting increased density in ADUs result in long-term impact of a supply surplus and lower market rents?
This is a great question because the very, very astute question here. So I think that land is going to appreciate because basically you can get more income out of the parcel than you would without those additional structures. On the flip side, though, each individual structure may command less rent because the supply of available rental units will increase. So both can simultaneously be true. And let me give you an example with some nice round numbers to see, like, you can drive rents down on the individual unit while driving aggregate rents up on the parcel itself. So if you have a 10,000 square foot piece of land with one home on there, let's take the Bolito as an example. Let's say it's a $800,000 property. It's a $3,200 rent as an example, which, feels about right for what it would be. And that's it, right? So you have $800,000 of property, you have $300,000 or $3,200 of monthly rent. But if you add the two detached ADU units on there, now you've got 3 income producing assets. So the original structure there loses a little bit of its land. So you would expect that, the rent probably shouldn't be as high as it was if you had the full lot. But now you have 2 additional structures where you can get 2 individual, households into those 1,000 square foot unit and a 1,000 square foot unit. Those rents are probably let's call them $2,000. So you have a 2,000, a 2,000, and maybe a 2,800. So aggregately now you have $6,800 of total rental income on that parcel that used to only support 3,200. So when you can increase the density of that revenue, the land value should go up. In addition, you have additional structures on there. So that's how it can simultaneously be true, where the main unit could go down in rent, but the parcel itself is generating more than double the income that it was before.
Fantastic. And since we're on the topic of rent, I thought this was a good one. And maybe we can walk through how we showcase it. Heidi had said, seems to me that the potential rental price is a bit low. So probably regarding the 2 properties that we have in there, would Arrive be very transparent about the final rental amount?
Yeah, absolutely. It is a big part of our transparency with our investors. And in fact, if you go to any of the invest pages within Arrive, there's a tab that's performance, and then you can see the full operational history of kind of watershed events as they're happening. So approved applications, leases. You'll see all of the rent rolls, like specifically on those pages. So definitely transparent about that. There's also financials that we post. There's audits that the properties go through. So you'll see a full spectrum of information available about the asset as well as the performance on all of Arrive Investments.
Absolutely. Our goal is to be as transparent as possible so you have a bird's eye view. Obviously, as we continue to scale, we want to be able to do that in tandem with scaling. And that's one of the pieces of information that's crucial for investors and them wanting to have access to. So great one. All right, moving back over. Ryan, I'm going to kick this one to you. To date in our private credit fund, what do we have? 61 loans, 16,000 investors. I think what is our SFR fund at? 27 markets, 57 properties. For the city funds, Seattle or like kind, is there a target asset allocation within a city fund, whether that be debt or equity?
Yeah, so it's a great question. I think within the city funds, the goal is to have the majority of the investments be equity investments into properties in that market that are generating rental income and then participating in the market appreciation. We'll mix in credit potentially up to a max of half of the initial assets of the fund. But really, as part of our cash management or treasury management strategy, it can add an increase to the yield initially.
Oh, Cameron, did you get a cutout here on Ryan?
I think you may be experiencing a little bit of Wi-Fi issue.
Little Wi-Fi issue. Cameron, do you want to jump in there? Oh,
He's back.
Ryan's back. There we go.
Well, I'm not sure where I cut off, but I'll kind of speak to the goal with the credit. Really kind of mix that in as part of our cash management or treasury management strategy. That way, we don't have to be forced to buy new equity investments. We can really wait until we find those offerings that we believe to be the best deal or best timing within the market, without sacrificing too much on the total return potential, since we have that as an option to invest in credit in that local market.
Absolutely awesome. All right, moving back over to the queue here. I think you chatted a little bit on this one, Cameron, but always a good one to double down. What will a sign be that the city is getting overheated, and how will the fund handle that? It's a great question.
Yeah, for sure. In terms of being overheated, I think that you really have to look at the fundamentals of what can be supported in that city. So to the extent that there is low inventory, that can be conducive to overheating. And what is that dynamic? I think that overheating is when the price increases beyond fundamentals too quickly. So if there starts being a real dislocation between people's income and, say, the price of assets, where maybe in the long run it's not sustainable, that's more of the sign of overheating that I would look for. It's tough though, because if people's incomes are growing and if the local economy is growing and if the stock market is going up and if people's equity is going up, you can see quick price increases, but it may be hard to argue that it's overheating. What I really fear from a real estate prices point of view is when too much supply comes on all at once. Because if you overheat and all of a sudden supply comes on and you have a lot of choices, that price will start going down because it's the natural supply and demand dynamic. So we look for the structural forces to say, is there a risk of a lot of inventory coming online all at once? Because if there is that risk, the more sensitive you have to be to the run up in price. So there's no one single metric that we can kind of divine. It's just participating in the markets on a daily basis. And that's what we do. We send out offers all the time. And if we see that, here's a sign that the market was getting overheated back during 2020, 2021, et cetera. When we would bid on properties, we would lose out to owner occupants who are bidding, on, let's say, on a $300,000 house, they might bid $360,000, $400,000. I was looking for a house for my own family in 2021 in the Seattle area, and there was some strong competition. There was cheap financing. There was people with a lot of income. Stock prices were rebounding very quickly after it kind of hit that low in March of 2020 when all of the COVID news was really first breaking. And for a while, I would say that it got overheated because you would see people throwing out very, very strong offers, and the market was trying to find a price, and it couldn't really find that price and triangulate on market value. That was a challenge at that point. I think the markets are kind of fundamentally stable right now. You don't want to see prices run up too fast. You don't want to see supply come on too quickly either and dump prices. I don't really see that dynamic going on right now. And a lot of it is controlled by interest rates. So 7% interest rates, they're higher than what we're used to from the last 15 years, but it's produced kind of a very stable market that's a little bit gridlocked. So I don't expect a ton of wholesale market just runaway prices. I also don't see the setup for the proverbial crash that a lot of people, call. Sometimes a lot of the bears and skeptics, they call, 10 out of the last 3 recessions, and they just constantly have a kind of a bearish nature. But I don't see the macro setup in terms of interest rates and equity to really produce that snowball of, falling prices. So I think we're in a good stable market right now, and that's where you can really capitalize on the thesis we're going for of the value add in the land.
Absolutely. Yeah. Great question. I realized there was some earlier on that we answered in chat, but didn't answer live. I know there was a question anyway that we have an option to 1031 in or out of arrived. I believe Eric mentioned they asked about a 721 upreit. So maybe Ryan, you can walk through current state, why we can't at the moment, and what we foresee for the future.
Yeah, so there's a couple of different questions about 1031 exchanges and then 721 exchanges. And really both of these represent a way to defer taxes on individual properties that an investor may already own, but maybe wants to convert either into new assets or into a passive portfolio. The 1031 exchange would be exchanging existing properties into new like-kind properties, and maybe within the context of arrived into an arrived managed asset. And then the 721 exchange would be taking a similar existing property that investor may own and transfer those assets in a tax-deferred way into an arrived managed fund, let's say. Both of those things are things that we're considering for supporting on arrived. We've gone through a couple different rounds of feedback with investors around what they'd be looking for on a service related to a 1031 or a 721 exchange. So we'd love to talk to folks who that would be of interest, where one or both of those would be something they'd be interested in and arrived. We're still kind of gathering feedback from investors to see what the best approach may be, depending on what we're hearing more often from investors as to what their needs are. So very possible long-term, something we're definitely interested in, and just an opportunity for, again, a way to defer taxes while maybe exiting some existing property investments that investors have, but would be looking to convert those into something more passive. So yeah, would love any feedback either in chat or reach out if 1031 or 721 exchanges are something that would be of interest.
Absolutely. I just dropped a poll to ask if anybody is interested in 1031. If it's 721 too, feel free to say yes there. I dropped that link that Ryan's referring to, so you can jump in there, or always reach out to support@arrive.com. We'd absolutely love to hear from you. So keep it coming our way. All right. I realized I missed a question from earlier. Ryan, is if Arrived invests in low income housing?
Yeah, it's a great question. So today we don't have any investments in low income housing sector. It's something that we have looked at from time to time, but not something that we've made an investment in yet. Within the Seattle market, the thesis is a little bit different to what Cameron had mentioned, where we're really investing in high quality existing rental housing that are in these transit corridors, and where we're taking this strategy around acquiring larger lots. So there is the opportunity to add additional income producing units to those lots over time. And really, whether we add those or not, there's the added appreciation potential that comes with the ability to add additional units that we sort of get the benefit of, or the fund can get the benefit of, whether we add those units to generate immediate income or not. So that's really the focus on the Seattle fund. And then the other thing I'll kind of mention just around the overall, housing supply and how to think about your investments into equity offerings and credit offerings. One of the things that we love about the credit product is that over time, we're actually adding more housing supply to the market through the credit investments than the long-term rental home investments. When you think about our credit fund, we've already just over the last year funded over 100 individual properties through that fund. And because the average duration is so short, less than 12 months, oftentimes maybe even 9 months or less, the rate at which we're able to recycle that capital into new properties, new home construction, new home renovation across the country allows us to add to the housing supply in all these markets that we're participating in faster than we're operating as a long-term rental. Since the anticipated average hold period on the long-term rental side is at least 5 years, up to perhaps 15 years for some of our assets, and so that short duration really helps with that within the credit category.
Absolutely, yeah. Ooh,
I'll
go
also
ahead.
just real quickly add on low income housing that there's kind of two flavors of this. There's government assisted housing where the actual units are that government assisted living type of unit itself, and then there is the housing and urban development Section 8 like voucher program to assist with low income people needing the rental housing. So we're a participant in the Section 8 market. We accept those vouchers. And in fact, a lot of areas you can't even discriminate against source of income for that. And I've actually found that Section 8 gets kind of a bad rap. I think people hear low income and they kind of immediately get this kind of concern about the tenant quality. And I've actually found that they're a very stable base of good paying tenants. And one of the incentive mechanisms to keep that in place is that if you violate terms of your Section 8 voucher, whether it be fraudulent or not keeping up, whatever the requirements are, you lose that and you have to reapply and get back in a long line. So it actually kind of coerces good behavior. And we found that to be a nice segment that aligns with more of a mission driven purpose while at the same time being able to, simultaneously deliver good returns. So I'm actually quite a large supporter of that. But on the government assisted housing side, that is a very different ball game, that your city is often going to be more of a participant than like the private market.
Absolutely. Looks like we have some feedback in the chat. Definitely appreciate it, Daniel. Moving over, Ryan, I'm going to switch gears briefly here because I feel like it's a good one to address live. For folks that are new here, new investments in the single family residential fund are temporarily paused as we complete our routine filing with the SEC to incorporate our most recent financials. Daniel had asked Ryan, how long do you expect the pause to last? And then I believe Richard had said, are the city funds the reason for the single family residential fund being paused?
Got it. Yeah, no. So the city funds are not related at all to the single family residential fund being paused. And yeah, related to the single family residential fund, we're probably a few weeks away from opening it back up. We filed our annual filing with the SEC, and usually they're pretty quick on turnaround timing. And then at that point, we'll be able to let people continue investing. And that's something that, from time to time, alongside our annual filings. We could see that we have to pause new investments with some of our funds, but other times it may be that we don't have to. So yeah, but we should be a few weeks away on the SFR fund, and we've made those filings now at this point.
Absolutely. Yeah. Something that's not atypical, whether it's quick or slightly delayed. We'll be sure to notify folks when you're able to invest again in the single family residential fund. For folks that have invested in that fund, this does not impact any of your existing investments. You can still track them as you would normally within your portfolio. Dividends are still on the cadence that's been communicated. So let us know if there's any questions there. All right. Hopping back over. I mentioned in the queue, we have about roughly 5 more questions before we close our virtual doors here. Cameron, what about the MDU in the city fund? Maybe we clarify MDU as well.
Yeah,
Mhm.
well, that's a terminology I'm not as familiar with. I'm assuming the DU is a dwelling unit. So to the extent that it fits within the Seattle or the state of Washington's parameters around a dwelling unit, all those options are available. But if you have clarification on the M part of it, I could probably address it more. But the House Bill 1337 specifically addresses the 2 accessory dwelling units, whether it's attached. Maybe the M is like mother-in-law. I feel those are often called the mother-in-law suite. MDU being multifamily. Okay, so to the extent that, let's say you have a lot, there's a duplex on there, right? So you're already in kind of the multifamily arena of that. For that property, you are allowed to put additional dwelling units. So any residentially zoned area that has an already constructed unit, you're allowed to put 2 additional units on there. Almost not no questions asked, because you still have to conform with various building code. Like you can't, have a zero setback dwelling unit. So it's not without some constraints, but from the state law preempts a lot of the zoning requirements specifically placed on additional dwelling structures. For new construction, it's a different set of legislation. That's not really that's not the right term. It's not applicable. At 1337 is not applicable to new construction.
Great question. So appreciate you clarifying in chat as well. Lots of different acronyms now that can mean multiple things. So appreciate it. All right, moving back over. This one's from David. Ryan, I'll kick it to you. Is Arrived moving away from its national model strategy now that the belief is that a local presence is important?
No. So for folks who are just kind of getting familiar with the Rives model, today we operate in over 65 cities, really across the country for our long-term rental properties and vacation rental properties. With the credit fund, that also added additional markets that we're able to participate in. And then now with the Seattle fund, a new market in Seattle. And across the board, we typically have a centralized acquisitions and asset management team. And on the asset management side, we're really working to create the playbooks for managing each of the properties. That might include things like how we approach leasing and things like pricing. And then we partner with semi-national property managers across the country to execute the kind of local operations with local residents. And so that's been our playbook and will continue to be our playbook, even within the Seattle market. I think the uniqueness with the Seattle market is we do have a strong presence with folks like Cameron here locally leading our investments team. And so, that certainly does play into our understanding of the market and our thesis. But we really believe that, Arrived as a company is about unlocking opportunity to diversify across the country. That's been something that's been really important to us from day one. And that's meant that we've had to build these great partners external to Arrive to help us support really, finding, acquiring, and then managing great assets all across the country. So that's still the focus. And, with the city funds, we'll likely add incremental cities. But yeah, that's our plan.
Absolutely. And I think this ties in well. And Cameron, I'm sure you'll have some commentary here. As a note, we're not registered advisors. We're heavily regulated by the SEC. So any information we're sharing here is strictly just around the investments, what historical returns look like, so on and so forth. Jim had mentioned, and I'm thrilled to hear you're on board, I've only invested in your credit funds, our private credit fund to date, because owning, for example, 500 worth of a $500,000 home didn't really appeal to me. City Fund is obviously more diversified. Do you see this as a better option for owning property, or just a different way?
Yeah, I think the city fund, the difference between a city fund versus an individual offering can be the differences are more articulated at the reason to invest, the thesis level of how you want to play a market to try to get returns, or play an asset class to get returns. So, you know, I'll say that about, the city fund versus individual offering, but from a mechanical point of view, whether you're in a fund or an individual offering, it's kind of the same mechanics of what do you own. So, whatever capital we need to raise for, say, an individual property, we then divide that by $10 to get the number of shares. So your ownership stake is proportional just to the amount of shares that you have. We have one class of shares, for those investments. So everybody is an equal owner in terms of what does that one share represent, but they have different allocation amounts. So if, totally understandable that, if there's $1 million asset and you own $500 of it, it may not feel like a substantial ownership percentage, but every investment on Arrived is a passive experience as a shareholder. So whether you own the max amount possible on it, or you own the min at $100 investment, you're treated the same economically, and it's the same passive experience, just the proportion is different. So I would look at it really as a portfolio building tool, that when we can chop up the atomic unit of these investments to these smaller pieces, it allows you to build a portfolio with a variable amount of capital. But the city fund versus individual offerings, those are mechanics, but I would really look at the investment thesis of the why. So if you want to bet on those larger DR Horton communities in the second and third ring with a newer asset, our SFR fund, our individual offerings, they all speak to that thesis. The Seattle City Fund is a very bespoke investment vehicle that mechanistically works the same as being a shareholder of any one of these other products, from the economics and kind of the ownership, but it's just a different asset thesis underneath. So that's how I kind of partition the two concepts of being an owner, and just really focus on what investment thesis do I like that resonates with me, and what proportion do I want to own, and then you can build your own portfolio that way.
Absolutely. Yeah, definitely great questions in there. All right. Moving back over to the queue here. A good one from Jim. Amazon threatens to leave every time Seattle raises taxes. Cameron, is this a concern?
Yeah, I think that it would be disingenuous to say it's not a concern if there's a large employer who, is dissatisfied in some way. But I think there's also, there's kind of the strategic element of what they say. And then there's the gravity of the situation. They got a lot of employees, they got a lot of buildings, they got a lot of operations and infrastructure that are embedded here, like to the very, fiber of the Seattle MSA. So, whenever they are, stating their position, they wield a large stick as far as, leverage. Sure, people will listen, but the counter to that is that that's going to be really expensive for them. So I think rather than moving out or changing, it's probably more going to be common to do what they did, was expanding a second campus in Virginia, right? They have this second headquarters that is East Coast based, and I think it's not just purely for economic reasons. I think there's very strategic reasons why they would want to be on both coasts. From they have a large data business, they have a large supply chain business. It's very advantageous to have hubs on both coasts. So I think that's what largely drove the decision, because when they were contemplating their new locations, it was largely East Coast based. So there's a very strategic business element of why go there. It's not like cost of living in that, DC area is cheap either. So it's not, it's not purely that. So I think there's an element of kind of grandstanding and signaling kind of what you want. And then there's the reality of like, how do you run that business that is this huge thing that is Amazon? It's not easy to like change very, very quickly. They're not a startup anymore.
Absolutely. Yeah. Always a good question. It's ever changing daily from all the different components that go into real estate and, companies moving. So very much appreciate you walking through it. I have two more questions in the queue. If there were any questions earlier on that I missed, please keep me honest in the chat while we're on the line. Otherwise, we'll answer these two and then we will close our virtual doors for today. All right. One from Eric. Will any of the city fund properties end up being reverse or negative geared? Cameron, I'll kick that to you.
Yeah, I kind of interpret this question to be, is it counter-cyclical in that if we go into a recession or if the market goes down, will there be benefits to owning that type of property? So kind of a high-level answer first. I think it's difficult to be short on real estate in the sense of like benefiting when value goes down. It's not quite like the stock market where you have these derivatives that you can buy a put, and when it goes down, then you're winning on your put because you can put it on someone else for a higher price. So to the extent that there's going to be a beneficiary in a very explicit way when if property values go down or if there's a recession, I haven't really seen the form of investment vehicle that facilitates that. Real estate tends to be a very long only type of asset. Now, where real estate can be negatively geared is if you have high interest rates, rentals can benefit more because the effective cost of ownership goes up. So when that cost of ownership goes up, affordability goes down. Rentals will tend to be a more preferred way of consuming housing. So I think that actually is very consistent with our thesis of creating more structural density on a parcel to support more renters. The detached ADUs themselves will tend to have a maximum size of about 1,000 to 1,200 square feet. 1,000 is the minimum maximum that a city can impose. So at least you can build 1,000 square foot detached ADU. So the more that you can add those housing units, the more it might be negatively geared in that the demand for those rentals will go up as housing becomes less affordable.
Fantastic. Awesome. And Eric, thanks so much for clarifying the chat. Definitely agree. Cameron, any commentary there?
Oh, it's not about meeting loan costs when the property is purchasing debt. Oh, got it. Yeah, so I think one of the advantages of the fractional platform is that everybody coming together and deciding that, hey, we want to invest partial in this asset, we can buy them all in cash. So we haven't had interest bearing loans on our investments for the last 2.5 years or so. Once interest rates got to close to 7%, we decided that it wasn't in the best interest of the investor to put a mortgage on a property. So we've been funding all of our investments collectively through cash purchases through the investor community. So yeah, the rent may not meet the cost when using the debt, especially if interest rates are 7 and maybe the rental yield is 3, right? It stops kind of making sense. Now, if you're really bullish on the appreciation, it actually may be okay to be negatively levered in that sense. And that could be a very intentional investment strategy from some people, because if you really believe that appreciation is going to be there in the short term, which is very hard to predict, but if you have that view, you could accept the trade-off of taking out a loan, paying the interest, having the rent not cover that, but you're getting levered on the appreciation. It's a reasonable trade-off. It's just a little bit risky and one that we haven't chosen to do, but it's not irrational either.
Absolutely. Eric mentioned appreciation is almost all you get in the San Francisco Bay Area unless you've held the property for a few years. Good feedback. All right. I think we cruised through the queue. I didn't see any additional questions that I might have missed earlier. It's been a fantastic, hour and 35, absolutely exceptional engagement. Fantastic prepared remarks, Ryan and Cameron. Cameron, do you have any closing remarks before we shut our virtual webinar doors?
Yeah, I'll just say thanks to everyone for joining, for all the great questions in chat. Korin, thanks for leading the session today. Cameron, thanks for leading the introduction to the new Seattle City Fund. And then a thank you to all of our arrived folks in the chat helping with Q&A today. This was an awesome webinar and look forward to seeing everyone next time.
Yeah, similarly, I'm always blown away by all of the great questions that our investor community has. Really shows the engagement, the participation, and I'm really just happy to be here to be able to have a very frank discussion with you all.
Absolutely. Well, Ryan and Cameron, thank you so much as always for prepared remarks, staying on for an hour 36 to answer the diversity of questions. Absolutely exceptional for our team. Thank you for being so involved in chat. You got to see everybody from all different teams on Arrived. Hopefully your voices feel heard. And for all the folks that joined, asked the questions, stayed engaged, answered polls, thank you. Thank you. We'll continue to build for and by you. I saw one last question here from Eric. Do you ever have investor gatherings in cities? We do. We just had one earlier this month in Arizona. We'll be sure to notify you if you're in that market, but we absolutely love having the opportunity to meet folks live. So happy investing and hope you all have a great rest of your day.
All right. Thank you all.
Bye all.